So you've got a big sum of money sitting in the bank. 30K, 50K, maybe 100,000 euros from selling your house or business or getting an inheritance. You know you should be investing this money, but you've got many questions. Should you invest everything at once or split it into pieces? Which investment app or brokerage can you trust with this kind of money? And how do you handle taxes? Of course, you're a bit worried because you don't want to make a mistake and risk your life savings. Well, I've invested hundreds of millions of euros for my clients over my career, and here's my guide to investing a big sum of money if you live in Europe. First, I've got to give you some bad news. You are losing money right now. I have a friend who sold an apartment a few years ago. He had 50,000 euros in cash. And it was so frustrating because I saw him sit on that money for years. And if you recall, a few years ago here in Europe, we had super high inflation. Everything was getting super expensive. In our country, in Latvia, inflation actually reached 20% per year. So in a single year, my friend essentially lost 20% of his money, 10,000 euros worth of value, because his money was just sitting in the bank doing nothing. Even in normal times, when you've got inflation of 2 to 3%, I mean, if you've got 100,000 euros in the bank, you are losing 2 to 3,000 euros per year just because prices are going up. So you definitely need to be investing, and you need to start as soon as possible. Now, once people realize this, they usually respond with, yes, I want to invest, but I want to do it safely. I don't want to risk my life savings. And it makes sense. I mean, you've spent so many hours working to make this money, you don't want to risk it. But here's the bad news. There's no avoiding risk in this life. You are taking risk either way. Either you take the really dumb risk of letting inflation eat your money, because it's pretty much 100% guaranteed that inflation will eat your money, or you take the smart risk of investing your money, where yes, there is some possibility of loss, but if you're smart about it, it's quite low, and you are very likely not just to beat inflation, but to actually make your money grow. Now, of course, if you will need to spend this money in the next few years, then you can't afford to take a lot of risk with it. You might as well just put your money in a high-yield savings account or in a money market fund. But these kinds of low-risk investments are not going to pay you a lot of profit. You can currently expect around 2% per year, which will probably not even cover inflation. But if you're investing for the long term, let's say 7 to 10 years or more, then you should be investing in the most profitable asset class out there, which is stocks. When I was younger, stocks seemed like something really abstract to me. I would hear about the Dow Jones or the S&P 500 on the news. I would see these stock tickers going up and down, and I just thought it had nothing to do with me. But actually, when you buy a stock, you invest in a real company. If you buy an Apple stock, you own a part of Apple. So that means you've got thousands, if not millions of people who work every day to make you richer. Now, there are very significant risks in the stock market. The biggest possible mistake that you can make with your life savings is to start buying individual stocks, to try and guess which stock is going to be the next Nvidia or the next Apple. If your portfolio only has a few individual stocks, you are very likely to lose your money. In fact, you might lose all of it. As many as 11% of the stocks in the market go to zero over time. As many as 40% at some point will experience a catastrophic loss of as much as 70%. But if you use a diversified approach, so if you invest in hundreds of different stocks in different countries, in different industries, then your odds of success are much, much higher. According to research, a good minimum number of stocks in your portfolio should be maybe 2 to 300. And this means there is virtually no chance that you go to zero. Okay, all of those companies are not going to go bankrupt at the same time, and you are very likely to multiply your money over time. Now, of course, as a practical matter, we can't build portfolios of 200 or 300 different stocks. It would be difficult to research that many companies, and it would be expensive to buy all those stocks. So instead of doing that yourself, usually you would use index funds and ETFs. Okay, so these are really simple investments. You buy one ETF, one exchange traded fund, and this fund goes on to invest your money in hundreds of different stocks. Here in Europe, the easiest place to find ETFs is a website called justetf.com. It's got a screener with almost 2,000 different stock ETFs. For example, the biggest, most popular ETF in Europe is the iShares Core S&P 500 UCITS ETF. which invests in big American companies. You've got the iShares Core MSCI World, which invests in stocks in many developed world countries. And you've got many, many other ETFs to choose from as well. Now, choosing the best ETF in your individual case is a little bit tricky. You have to take into account your age, your goals, how much risk you're willing to take, and also the tax rules in your country. You might be interested in my step-by-step guide to choosing the best ETFs. It's the first link in the description. So, if you invest in the stock market with index funds or ETFs, does that mean you get to avoid all risk? Well, certainly not. Okay, you get to avoid individual stock risk. Okay, you're not going to buy one Enron or Lehman Brothers that goes bankrupt, but you've still got market risk. For example, I remember getting started on Wall Street 18 years ago. It was the financial crisis. I sat there on the trading floor watching all the charts go red. I mean, the market dropped by 50%. It was super, super scary. Even if you were invested in a diversified portfolio using index funds and ETFs, you would have seen big, big losses at a time like that. Now, happily, this is not actually what's normal for the stock market, okay? On average, 3 out of 4 years, the stock market goes up. It goes down maybe 1 out of 4 years. And usually, even if it goes down, it doesn't go down that much. These really huge disruptions, these big, big crashes, they are quite rare. Okay, but when they happen, they are so powerful emotionally, they scare us so much that they really stick in your memory. And a lot of people spend all their lives fearing the next crash, even though they might only experience 2 or 3 crashes over their lifetimes. In practice, one of the biggest challenges for long-term investors is being able to stay calm when these disruptions happen, when the market goes down. Because if you stay calm and stay invested, the market virtually always recovers. Many people did freak out and sell at the bottom of the crash. They lost money, but investors who stayed calm and stayed invested, they did really, really well. This actually leads me to one of the biggest problems I see with beginning investors who have a large sum of money. But before I explain this problem, let me address the most popular question that I get about investing big sums, which is, do you invest everything at once or do you split your money into parts? This seems like a simple question, but it's actually quite complicated because there are 2 valid answers to the question. The first answer is statistical. If you purely look at market data, then the answer is clear. You should take your whole 100,000 euros or whatever amount of money you have and invest everything in the stock market at once. But the problem with this is that we are not robots. We feel emotions. We get scared. And if it's your first time investing and you've got your life savings and I tell you, well, put everything in the market and you will probably be fine. I mean, maybe the market crashes tomorrow, maybe not, but most likely not. You should be okay. It's going to be very hard for you to accept this advice and actually invest all your life savings at once, right? In reality, I've seen that people who are told to invest all their savings at once often end up delaying and delaying and delaying for months or even years. So the second answer that I believe is also valid is it's fine to start small. It's fine to split your savings into 5 parts and invest over 5 months. It is even fine to start with just 100 euros if that's what it takes. The human mind is a funny thing. You might imagine that investing 100 euros wouldn't really help you that much with investing 100,000. But actually, once you move past that first mental roadblock, once you make that first investment, you might find that investing a lot more is not that difficult. All right, but now I want to address one of the biggest problems that I see with beginning investors who have large amounts of money. You don't know much about investing, you don't want to make mistakes, maybe you don't want to spend a lot of time learning how to invest. So you say, I'm just going to go to my bank and let them invest for me. There are 2 significant problems with this approach. To understand the first one, imagine this. So you've got kids, you find a nanny and you say, well, I don't want to learn how to raise kids. I don't want to deal with all this complexity. You raise my kids and I'll just pay you. Would you get a good outcome? Probably not, right? And it's actually the same with investing. Because if you simply give your money to somebody else and you don't know what they're doing with the money, you don't know what's smart and what is dumb, it can lead to all kinds of problems. You can get taken advantage of, but even if your banker is doing everything right, you will never feel confident about what is happening. You will always have fear. Like, is he or she investing my money in the right way? When the market falls, you will never know. Is my portfolio down because the market is down and that is okay? Or is it down because my banker is an idiot? So handing over the responsibility for your life savings to somebody else leads to really bad outcomes, and it leads to a lot of stress. And the second problem with this is, of course, that there's no such thing as a free lunch in investing. So when you go to your bank to invest your money, they're going to charge you a fee for that. And it might seem small, maybe 1 or 2% of your money every year, but the effect this has on your investment results can be huge. So let's look at a simple investment calculator. Let's say you're investing for 20 years and you've got 100,000 euros. Now, the long-term average for the global stock market has been 9% per year. So let's say you get that, then over 20 years, 100,000 euros would become 560,000, which is pretty nice, right? Now, of course, we have to subtract inflation. So let's say we've got 3% inflation per year. So that leaves us with a real profit of 6% per year. So our 100,000 euros becomes 321,000 euros, which is still pretty good. But now let's assume there's a banker in the mix and we have to pay them, let's say 2% per year. Then our profit would fall from 221,000 over 20 years to 119,000, almost by half. So the question is, are you willing to pay this price? In my personal opinion, anybody who's got significant savings should take a bit of time and learn the basics of investing, because you can get the same or better results than your bank would get for you with just a little bit of skill, spending just a few hours per year. I know that this is true because as an investment trainer, I've helped thousands of people all over Europe learn how to invest their money. Now, when you are investing on your own, let's say you invest in a portfolio of ETFs, you're still going to need a financial company, an intermediary called a brokerage, to buy these funds. Now, here in Europe, we've actually got a great choice of many different brokerages that you can use. For beginners, I often recommend very simple brokerages like Trade Republic or Trading 212 or Lightyear. But when it comes to investing big sums of money, I personally tend to prefer the biggest, most established brokerages with the strongest reputations. So in that case, I would look at either Interactive Brokers, which is part of an American public company. It's got a stellar A- credit rating. I mean, this is a really big, major online brokerage. Or I would look at Saxo, which is a Danish bank, also very strong financially with a great reputation. Now, there are a few points you should keep in mind. Interactive Brokers is quite difficult to use. It's got a technical user interface because it was originally built for professional traders. So expect that it might not be so easy to learn how to use it. I've actually got a video about how to use Interactive Brokers on my channel. You can look it up. For Saxo, well, this is also quite a technical brokerage, maybe a little simpler than Interactive Brokers. But the main issue I see is that in many European countries, Saxo still has some pretty high fees. So depending on where you live, you need to pay close attention to the list of fees. I cover how to choose the best brokerage for you and how to use these brokerages in my step-by-step training program for European investors, the Index Masterclass. You can find out more about that using the first link in the description. But now I want to address one more crucial problem for investors with a significant amount of money. Almost every week, somebody reaches out to me and says, "Well, Tom, I've been investing in ETFs for the past few years. Do I need to pay any taxes?" That is not good. As soon as you make your first investment, you become subject to investment taxes. Now, if you're just investing 100 euros, chances are your local tax authority is not going to care. But if you're investing large amounts, you can get into big trouble by ignoring taxes. Now, don't let this scare you. All you need to do is figure out investment taxes before you start investing. I would look at 3 main topics. First, tax residence. This is important if you're an expat. If you move to a different country, you need to figure out in which country you need to pay taxes. Second, capital gains. So when you buy an ETF and then you sell it at a higher price, you have a profit. That's called a capital gain, and you have to pay tax on this. And third, dividend taxes. When your investment pays you some dividends, you need to figure out what taxes you need to pay. All right, so your goal should be to figure out what are the taxes that I need to pay? How do I calculate them? How do I report them and pay them? And then, of course, how do I optimize taxes? How do I reduce my taxes legally and ethically? All wealthy people pay close attention to this. If you want to preserve your wealth and make it grow, you need to understand the taxes in your country. Now, if you would like my help with this, if you would like to start investing with the lowest risk of expensive mistakes in the simplest, easiest way possible, you might enjoy my training program for European investors, the Index Masterclass. I've put together a step-by-step guide to investing from Europe, including local tax briefings for pretty much every country in Europe. And I work closely with our training members to make sure you never get stuck. So if that sounds interesting, just follow the first link in the description.